for us to go ahead and start. So thanks everybody for joining us here for Financial Modeling 101. Super excited to be talking to everybody today. And this particular presentation, this topic is really important to me because I've worked with a lot of companies over my career. I've had some really promising looking companies that have ended up actually failing. And it wasn't because their business model was broken or because they weren't getting good traction or anything like that. And it was simply because they just lacked the resources and the know-how to adequately forecast. And then they ultimately just ended up running out of cash. And it's a super tragic thing whenever that type of thing happens. You never want to see that happen to any company or any startup, but these types of things happen all the time. So some of the content that I'm going to be going over today is really going to help put up some guardrails that can help you ensure that you don't fall into a similar situation for yourself. So we'll cover some of the basics of financial modeling in the presentation. We'll dig into things like what is a financial model and what are the benefits of financial modeling and the overall impacts that financials have on a company. And we'll keep it a hands-on session. We'll dive into some real world examples. There's a lot to cover, so I'm just going to go ahead and jump in. So I always like to start off presentations by talking about the objectives. So what are the things that we hope to cover and what are the things that ultimately we want to impart onto you by the time the presentation's over? And ultimately, it's just two things. It's I want to show you the power of a financial model, the types of things that a financial model can do to help you, and in particular, how it can help you raise money and it can help you run your business better. So we'll dive into each of these separately. And I also want to talk to you about how to properly build a financial model. So we'll go over some of the best practices and we'll dig into an example ourselves so that you can take a lot of what we talk about and then you can operationalize it for yourself. And just to run through a quick agenda, we're going to be talking about why financial modeling is important and the purpose of it. We'll walk through what a true investor grade financial model looks like, and we'll talk about how you can build a financial model on your own, and then how you can use it once it's actually built. But before we get into any of that, I want to give you a really quick introduction on myself. So I'm Logan Burchett. I'm co-founder, chief operating officer of Forecastr, and I've been in finance for more or less my entire career. I started off my career working at the Kentucky Pension Fund. I was managing their stock portfolio. Eventually, I left and became a fractional CFO / head of finance for dozens of venture-backed startups. And this is really where I honed my craft. And it's what led me to starting Forecastr. But even more importantly than that, it's what led me to my co-founder, Steven. And between the two of us, we built well over 200 financial models. We both raised money from investors. And I'm a finance mentor at Gus, Techstars, New Chip, GSV, and know the startup finance game better than most people you're likely to meet. So, sorry, yeah, Mitch, you already fielded that question. I was going to say I saw the question come in. Will there be a recording? But you're already on top of it, so I'll get there. So I want to talk a little bit about what Forecastr is. Forecastr is an online software. It helps founders build great financial models so that they can understand their numbers, make better decisions, and get funded. And really the heart of what we're doing is making forecasting easier and more meaningful for founders and investors, because we love forecasting, but we really hate Excel, which is kind of ironic because we used to be professionals at it. This is what we did day in and day out, and we're deemed to be experts by many people. But Excel's clunky, it's hard to learn, but above all, it's unstandardized, which means that every model that you build is different. It's nearly impossible to compare or automate anything in Excel. In Forecastr, every model is still unique, but it's standardized within our own platform. So that way you can compare yourself to your cohorts, link up your data sources, and it makes it smarter and way more efficient. And we also have a team of experts that help you along the way, from the initial build of the model to any ongoing questions, any ongoing support you need. So if you're interested in Forecastr, we'll send a beta application out. Looks like Mitch just sent that. But we encourage everybody on here to apply. We'd love to chat with all of you all and learn more about you. And I'll go ahead and jump in on this one question I saw just pop into the chat. How is it different than LivePlan? I actually get this question a lot. So LivePlan actually started as a business planning software. It's really geared towards just creating like a solid, cohesive, like business plan, in written form that you can then present to investors along with a pitch deck or something like that. They kind of started adding the forecasting to it almost as an afterthought, and they've got it to that it'll feed into your business plan, which is nice, but it has a ton of limitations. So forecasts really need to be customizable. They need to be flexible. They need to be able to simulate a revenue formula, which we'll get into here in a little bit. The extent of live plans forecasting is really just X times Y. So like a price times quantity that you can go in and augment and adjust, but it doesn't really tell the full story on kind of like, it doesn't tell the story of like how you're going to be, generating revenue, how you're going to be monetizing customers, the cohesive kind of like business plan that you have, which is where Forecastr comes in. It's more cohesive, more, it encompasses the entirety of what a financial model needs to be rather than just kind of like a more simplistic, X times Y is what you get with a live plan. So before we move into the content, I want to start by making sure that we're all on the same page with what exactly a financial model is. And this also kind of double taps on your question, how is this different than live plan? This will kind of like get into kind of the mechanics of that. So if you ask 100 people, what is a financial model? You're more than likely to get 100 different answers. Model can have a bunch of different functions. So it has a lot of definitions depending on who you talk to. It can be things like an expense budget, hiring plan, cash forecast. There's like a really big span of the things that a financial model can do. So the best definition that I've heard, and the one that we like to use a lot, was actually coined by a guy named Troy Hennicoff. He was the former MD of Techstars Chicago. He runs a venture fund called Math Venture Partners up in Chicago too. He's a close mentor of ours. But he uses an analogy that I think is perfect to describe financial models, and it goes like this. So back in the early days of car manufacturing, the design phase looked a lot like it does in the picture shown on the slide. So you'd have engineers that would build out these full-scale replicas of their designs, and then they'd eventually create a prototype, a working prototype of these big clay replicas. And then they'd have to find somebody to jump in, and then they'd have to test out these prototypes that have never been used before, but they'd have to do it in real time. So you'd have a tester that would jump into these unproven machines, and then they'd have to take them for a spin. And sometimes that would work well, but then sometimes, the car would flip over into a barrel roll whenever it was trying to take a sharp 90-degree turn. But you really don't know how it's going to work. The only way to know how it's going to function is to just build it and test it. So they basically had to create an entire car just to see if their concept works. And a lot of times it didn't, and it was back to the drawing board. So you'd have several iterations and millions of dollars later, and eventually you might have a car. This is absolutely crazy by today's standards, wasting a ton of time building all of these early models, risking lives in the process. And thank God for technology, because nowadays cars are built soup to nuts using software. They can be designed and tested in minutes and not months. Virtual cars can drive on virtual tracks. They can take sharp 90-degree turns. If the car flips over into that barrel roll, it's fine. Nobody gets hurt. You just tweak a few components, maybe like lower the center of gravity, whatever it is you need to do. And then you try it again, and you keep doing this until eventually you get it right. And the idea of building a full-on physical prototype before any software testing is completely laughable in 2021. And it's the perfect analogy, I think, for a financial model, because in the same way, using technology, you can simulate your business and you can run tests in minutes instead of years. So you can see what happens when you add that new product line, or you try that new marketing channel, or you invest in a sales force. And early on, you can even understand, is your business even viable, or do you need to switch up your entire business model? And that way, you're really seeing how your business can handle that 90-degree turn. Is it going to perform well, or is it going to flip into a barrel roll? That way, if there are issues, nobody gets hurt, not your investors, not your co-founders, nothing like that. And it also gives you a chance to optimize before jumping in feet first, wasting a ton of time and money. So make no mistake, financial model is one of the most powerful tools that you can have in your arsenal. So we hit a lot of people that say, hey, I don't need a financial model. I don't need projections, just because I have QuickBooks. So all of my financial data is encompassed in my accounting software. And QuickBooks is super important, but it doesn't tell you the full picture. Accounting really only tells you a small piece of the story. So if you let me continue with this car analogy, you can think of the accounting as that rear view mirror. So it tells you things that have already happened, things looking back in the past. It's still important because it allows you to do retroactive analysis and try to understand where you could have improved, but it doesn't do anything to tell you about what's coming up the road. I mean, if you're driving a car and all you're doing is looking in the rearview mirror as you're driving, I mean, you'd be a hazard to yourself and everybody on the road. You'd never do something like that. So to properly run your business, you need to see that full picture. You need to make sure that you have that clear windshield so that you can see the things that are coming out ahead of you. I'm going to keep going on this car example. So I'll hear people say we track KPIs to help make sure that we're on track. So, we don't need a forecast because we're always on top of our metrics. We're always staying on top of our KPIs. But KPIs still don't tell you what's coming up the road. So coming back to that analogy, you can think of these like your dashboard, your odometer, your gas meter, things like this. They'll give you data in real time, letting you know how your business is functioning. And these are really important things to keep track of. But again, they're not allowing you to see what's coming up the road. And the only thing that gives you the rest of that picture is a financial model. The financial model acts as your windshield. It gives you a clear vision, and it'll empower you to make educated and informed decisions about the future of your company. And a proper forecast is really, we think, the only thing in your business that's holistic and powerful enough to allow you to make the kind of forward-looking, forward-thinking decisions that you need to in a really transparent and ultimately responsible way. Okay, so I've thrown a lot of analogies out at you, but I want to talk a little bit more practically about why we build a financial model. And whenever it comes down to it, there's really two value props of a great financial model, but they're super, super important value propositions. So the first thing that a financial model will help you do is it'll help you impress investors and it'll help you raise capital. The best way to communicate with an investor is in their own language, which is in the language of finance. It can also help you understand your cash position to help you articulate your growth strategy and your expenses to your investor. Model can also give the investor a clue to your understanding of your own business. It's kind of a separator in a way, because if you don't feel confident or fully understand your business, a lot of that will come out in your articulation of your financial plan, which is done through your financial model. So it'll also help you run your business better. Again, a financial model is a simulation of your business. It'll allow you to make informed decisions. So it'll help you figure out the best ways to spend money in order to manage your runway. It'll also allow you to create a multitude of scenarios and find the optimal path. And these two values are super, super important. Can't be understated. So help you raise money, help you stay alive. Both of these are super, super important. So now let's get into the expected output of a financial model. What are the things that my financial model needs to produce in order for me to have appropriate communication with investors to make these types of informed decisions? So the output of a financial model comes in the form of the three financial statements. And I'm sure some of you have heard of one or all of these statements. At some point, we're going to go through at a very high level what each of these mean. So we have the income statement. This is the statement that shows you how much money a company is making or losing over time. This is where you're going to report on things like revenue, expenses. It'll show you what your net income is for your company, but it shows you these things over the span of time. It's also a good place to get a sense of margins, how much money you're making or losing, your gross margin, all of that stuff that we'll get into a little bit later. The balance sheet, on the other hand, shows you what the company owns or owes at any point in time. The statement of cash flows then sits in between those two statements, and its only job is to tell the story of what's happening to cash over a period of time, because cash is constantly changing. It's like oxygen for business. It's something that we're all really, really focused on. And because it's so important, it has its entire own statement. So really the three statements are the main outputs of the financial model. Because there's so many different moving pieces of a financial model, a lot of times we're asked, what are the most important things to focus on? What are the things that I really need to make sure that I get right? And what do I need to spend the majority of my time focusing on so that I can really hit home with investors? So by far, the thing that is the most important is revenue. Revenue is the hardest thing to predict. It's the most difficult thing to control. And it's the reason that most businesses end up failing, is that they don't end up hitting their revenue targets. And because revenue is so important, it's really important that you understand your revenue formula so you can identify all of the key drivers that go into calculating revenue. Once you really fully understand your revenue formula, you can understand the different things that you have control over and that can impact your revenue revenue. So we're going to dive into an example of a revenue formula right now and get really into the weeds with it. So this formula is for a subscription business model. And before we dig in too far into this, I'm going to call out that we built this intentionally. You'll see it's going to be like a tree-like structure so that you can understand all of the subcomponents of each metric and how each individual metric is calculated. And you'll notice that that key down there in the bottom left-hand corner, we're going to keep all of the input values covered purple. And we're defining inputs as things that we have either direct or indirect control over. So these are things that we can either change really, really quickly, like you'll see price, which is right there, or things that we can optimize over time. But we do have a way of impacting it. That's really what causes them to be inputs. The goal of our revenue formula is to start at this highest level, and then it's like a layer of an onion. We're going to keep peeling back one layer at a time, keep going deeper and deeper until we get all of our metrics, all of our base metrics are going to be those purple input metrics. So in this case, if we're starting at the highest level, we show price times subscriptions equals revenue. That's the absolute highest level that we can start at. My price is that purple input. It's something that we have direct control over, but notice that my subscribers is gray. There's way more nuance to calculating subscribers. There's a lot that goes into this. So if we go one layer deep on subscribers, then we can see that my subscribers equals my subscribers at the beginning of the month minus any subscribers that left me plus any new subscribers that I got within the month. And we can see further that my number of subscribers that we lost is calculated by taking the subscribers that I had last month times the percentage of the churn, which is also that purple input metric, that churn rate. There are a lot of different ways that I can get new subscribers though, and we can see this in my revenue formula. I can get new subscribers through Google, I can get new subscribers through email, and I can get new subscribers through Facebook. So we'd want to understand the math that goes into each of these individual customer acquisition channels. On this slide, we're going to just dive into Google to keep things simple. So we're going to be looking at just one of these. So we can see that our new subscribers from Google is our traffic from Google multiplied by our conversion rate. Now, our conversion rate is going to be a purple input metric because we have indirect control over that. Our traffic, though, is something that we, in theory, can only control by our monthly budget divided by our cost per click. And both of these are purple input metrics. So if we wanted to increase or influence our traffic from Google, therefore our new subscribers, therefore our total subscribers, therefore our revenue, we can A, spend more money on paid ads, B, find cheaper keywords, or C, we could increase our conversion rate through trying to optimize, our conversion rate over time. We could also increase our revenue by reducing churn. Lower churn would decrease the amount of subscriptions that we lose over time, which would increase the number of subscribers, which would increase revenue. So if we take like 10 steps back, we can really see the value of a revenue formula because there's really only 5 purple inputs on this slide. And that means that there's really only 5 things that we have direct or indirect control over that can ultimately impact revenue. So we can modify our price, our churn rate, our conversion rate, our budget on paid ads, or our cost per click. So our job as owners of the business and managers of the business is to figure out which one of those levers has the highest impact and then optimize those over time until we're generating the maximum amount of revenue. So it's really strong clarity that you get through your revenue formula. What are the things that I need to focus on? What are the things that I have influence over? And then creating a game plan to optimize the ones that have the outsized impact. Okay, so now we're going to go through a specific example. And this is an example for a business called Dollar Cave Club. It's kind of a cheeky business that Troy Hennicoff made up. And I'm stealing that analogy, much like I stole the car analogy from him in the earlier slide. So I'm stealing this one from him too. So I'm going to pause for about a minute and I'm going to let everybody read this prompt and then we're going to come back and we're going to dive in together. So take a minute, read this, and then I'll come back in here in just a little bit.
Hey Logan, can you make sure that your screen share is pinned? I don't know. It may not be the main screen, or I'm not sure if that's just on Richard's end. I can see it fine. Like, um,
You're testing my knowledge of how Zoom webinars works. So let me see.
let me ask the rest, guys. Can you drop in chat if the screen that Logan is sharing is taking up the whole screen, or if it's not? It's okay. Okay. We should be all good then.
Okay, cool.
Thanks, guys.
There you go. Yeah, appreciate it, y'all. Okay. All right. And apologies for all the slow readers out there. I'm a slow reader myself, so I totally get it. But we're going to dive right in now, and we're going to walk through this specific example of Dollar Cave Club. And specifically, we're going to put our strategic business, owner hats on, and we're going to try to understand the impact that a change in price is going to have for the business. Cool. So, Mitch, am I good here? Can you guys see this? Very, very cool. Okay. So this is Forecastr. So for those of you that haven't seen it, which I assume is probably everybody on this call, this is Forecastr. It is what is used to replace Excel to build out really great financial models. So today we're going to be looking at Dollar Cave Club's financial model. So I'm going to do a really quick orientation on what's going on here. Then we're going to try to run through a couple of scenarios just to understand kind of where we should be focusing on the business and things that we should be looking into. So if you're looking at my screen, I'm going to go down this left-hand column just to kind of show the different relevant sections. I'm looking at customer acquisition right now. So this is outlining the different ways that Dollar Cave Club is getting customers. They've got people that are organically going to their website. So if I expand this, I can see these are their website visitors, the website traffic, and then these are the new customers that they're getting from that. So they're just inputting a conversion rate to understand that. You can look at Facebook ads. So this is where you can see the budget, from their Facebook ads, cost per click, how they're getting all of that stuff, all of their traffic from Facebook. Similar deal with Google, and then they've got customer referrals. If I go to my revenue streams, we can see all of the different ways that they're monetizing this. So you can see that revenue formula that we just went through on subscribers. All of that is outlined here. We've got some nice hover, functionality that shows you how all of the calculations are working, but it's essentially that mathematical representation of that revenue formula as is reflected. As we just read on the prompt, you've got the 3 different revenue streams. You've got subscribers, you've got add-on purchases, and then you've got advertising. For the sake of time, I'm not going to go through everything here, but I'll just note that you've got some expense sections where you can see your people, you can see your other expenses and how that's going to be growing over time. And then you've got your other sections that show like your assets, your cash, your liabilities, your equity, all of that stuff. And then all of this is going to feed into our financials. So our 3 statements that we covered earlier in the slide, our income statement, our balance sheet, and our statement of cash flows. So like most businesses, Dollar Cave Club is going to be burning money. So it's very unprofitable right now. But then if I scroll out to the right, eventually it's going to hit this point where it flips over and becomes profitable. And you can see that eventually we're going to get at these nice, 20, 30% net margins. So looking pretty good on that front. Now, if we look at the balance sheet, though, this kind of poses a problem because we're not profitable. We got about $300,000 of cash right now, but we're going to burn through that cash and we're eventually going to run out of some money. So it looks like in April, we're going to end up going negative on cash. So the first thing I'm going to do before we kind of start running our experiments is I'm going to go into this equity section. I'm going to get another investment in here. So we already got one investment at $350,000. I'm going to add another one. And I'm going to have that investment come in April, let's say. So let's say we run out in April. So I'm going to have this come in April. And I can name this, seed round or something like that. And I'm going to make this $2 million, let's say. All right. So I'm going to hit done there. You can see kind of like how things are working. If I go back to my financials, and now I look at my balance sheet, voila. Now you can see cash goes up pretty significantly. And then if I scroll out to the right, that gets me good until September. So if I raise 2 million, I'm going to be good until September. And then we can actually see this on the dashboard. If I go here, it's going to tell me what my runway is, and you can actually see that raising cash, what's happening here. I've just raised cash. Cash has gone up. That buys me about 35 months worth of runway, and I'm not profitable until month 53. So I now understand kind of like what my marching orders are. If I raise 2 million, then I can hit those numbers, then I can go and raise more money after that. But for the purposes of this conversation, we're going to try to go through what are the key areas of focus for my company, right? So I'm going to go back to the financials, and I'm going to use something to anchor us to make our business decisions off of. So, ultimately the best sign of profit, or the best sign of success for a business, or one of the best signs of success, is the ending cash balance for the company. So you can see right here, if I keep everything status quo, in October of 2027, my cash balance will be, assuming I don't raise money, obviously I'd have to go raise more money, but currently it would show that I'd have $522,000 of cash in my business on October of 2027. So you guys noticed early on that my price was $29.99 per month. So if I go back here for my subscriptions, I'm going to look at this as $29.99. So I'm going to double this right now. I'm going to double my price. And in the chat, I want you guys to theorize, what do you think is going to happen to cash? Do you think that it's going to double? Do you think that it's going to more than double? Or do you think it's going to less than double? So go ahead and put that in the chat now. And if you guys want to throw in kind of like your rationale for your guess, go ahead and do that as well. But this is one of those fun experiments just to see what's going to happen. More than double. Okay, cool. Way more. Okay, there you go.
And maybe while we're waiting for the answers, Logan, we did have two questions. So first is about cap table changes from Pablo. So he's asking if we include any cap table changes in the equity rounds.
What do we mean by cap table changes? Be good to get like.
Yep. And while we wait for that, we do have also, was the assumptions prompt for text comments, or does it have an option for numerical inputs?
Yeah, so if you're looking at the assumptions, if I go in here, you can see that the assumptions are clearly outlined as inputs. Those are the things that you can change. So it is like, it gives you the ability to put in, numerical inputs, and you can define them however you'd like, but then you can also name those inputs whatever you'd like as well. So in this case, we've got our monthly churn rate. It's denoted as monthly churn rate. You can see here that it's 4%. Hopefully that answers your question, but let me know if that wasn't quite what you were looking for.
Cool.
Okay, so let's go and check this out. So it was, what was it, Mitch? Do you remember 570,000, I think, somewhere thereabouts? That's what cash was.
Sounds right.
So I'm going to go here back to my financials. All we've done is double price. So we're going to see what happened to cash at the end of this. So I'm going to go in here, cash, scroll way out here. Look at that. Look at how much cash has increased by. It is now $6.68 million. I mean, that is a tremendous, tremendous impact by just doubling that. And we can, if we really wanted to dig into the revenue formula, we can start to kind of understand why. And it's because if I double price, then I'm not just getting an extra $30 per like for that one time, for that 1 month. Our churn rate's only 4%. So that means I'm getting an extra $30 literally every month from every single one of our clients throughout the entirety of the model for as long as they stay with us. So price is an incredibly powerful lever for this particular business. Now, it's important that you understand your revenue formula, because if this was just a transaction business, if it was just like a one-off, like I just charge this thing once, price isn't going to have nearly as big of an impact, because I'm only getting that change in price. I'm getting the benefit of that one time, versus this business where I have a low churn rate. I get the benefit of that, every single month. But this doesn't tell the full picture, right? If I increase my price, then what's going to happen to my conversion rates? What's going to happen to my churn rate? In this case, I'm going to go in here and I'm going to look at my conversion rates for customer acquisition. And I'm just going to go through here and I'm going to say, okay, if I double my price, what happens if each one of my conversion rates gets chopped in half? What happens if I now convert literally half of the people at that higher price than I did before? So I'm going to go into each of these. I'm going to look at my conversion rate and 0.75, because I'm bad at math if I don't have Excel in front of me. That's going to be 0.375, which I definitely should have done in my head, but I'm going to do it here anyway. And I'm going to go in here. This is going to be 0.5. So I've just cut it in half. And then last but not least, customer referrals. Make this 25%. Cool. Okay. So now I just doubled my price. I've cut my conversion rates in half. What do we think is going to happen? Am I better off or am I worse off? You can throw that in the chat as well. Any brave souls that want to? And I'll even say, I don't even know the answer to this question, by the way. We're going to find this out together. But that's the point. It's hard. You know, you don't exactly know what the answer to the question is going to be because there's so many moving variables. That's why a financial model is so important. But let's go find that together. I'm going to go to my financial section. I'm going to go to my balance sheet. I'm going to look at this. And again, I have not tested this, so I really have no idea. We're better off by almost double. We've almost doubled our cash at the end of that. So what does that tell you? That tells me as an owner of this business that I can increase my prices if I double my prices, I can afford to close half of the customers. More, I can do even less than half of the customers. And at the end of the model, I will have doubled my cash. I will be better off. I am significantly better off if I charge a higher price, even if it decimates my conversion rates, I'm still better off. So why is this so powerful? Well, it's because now I can run an experiment, right? I can go for my next 100 customers and I can offer them the same product at double the price, and I can measure my conversion rates. If my conversion rates fall, so long as they fall by more than half, you know what I mean? Or like less than half, then I know that I'm better off. So that means that now I can just start charging that higher price. Like let's say that my conversion rates only drop by 30% after that test. Well, then it's a no-brainer to me. Just start charging more money and then ultimately I'll be significantly better off. So these are the types of things where you can go in, you can test with a financial model to see what the downstream impacts of your business are going to be. And if they're positive, you can set parameters at which other metrics need to fall into. And as long as they fall into those parameters, then you've got your marching orders. We could stay here for a long time and get super granular with this stuff and say, try different conversion rates by each individual channel. And then we can like set our measurements based off of that and go really, really deep into it. We can also, if we wanted to, we could go into churn rate and say, what happens if my churn rate increases and all of this stuff. So I think that, this is the type of stuff that really gives you a ton of focus on what you should be paying attention to. I'll say one last thing on this before we jump back into the presentation. But one thing that you might notice is like my advertising revenue. If I go way out here, I'm making, $300,000 a month. And I'm making $700.44 off of my advertising revenue. I'm going to go in here. I'm going to edit this and I'm going to say, what happens if my CPM doubles? What if that goes from 8 to 16? What if I spend all of my time on that and I get that, up significantly higher? This isn't doing anything to this business. Like I could focus a ton of time, a ton of attention. I can get my page views up. I can get my CPM up. I can do pretty much everything that I need to like focus all of my time on that. And it is not going to move the needle at all. It is doing absolutely nothing. And this is also, I think, something that is very, very important when it comes to financial modeling is it's just focus. I should just delete this revenue stream, right? I really should. Like, it's not going to do anything for my business. And as a founder, I'm getting pulled in so many directions all the time that one of the really important things to understand is where should I focus my time? It's surely not on advertising. That's not going to do anything. So don't focus on it. I would argue to even just take this out of the model and operationally just chop everything that has to do with trying to maximize advertising revenue, because it's just not going to move the needle on anything. And you could even argue the same thing for add-on purchases. You know, even it's a lesser degree. I mean, 15,000 on $300,000 of subscription revenue, just not going to move the needle a whole lot. So shows you my focus is on subscriptions, and you know, really my focus is not only on subscriptions, but it's on the different things that are going to maximize that subscriptions revenue. We just uncovered that price is a big thing. So anything that I can do to move that value proposition up to be able to charge that higher price, that's what I need to do. That's my marching order. So that is a very, very quick, you know, little test drive that we just took our business on and gave us, I think, a lot of clarity.
Awesome. Yeah, and then a point from Aiden. So he brought up that what you're doing right now kind of could be considered a break-even analysis, and Forecastr is like a good tool to do that in. Yeah, just curious your thoughts on that.
Yeah, no, definitely. So that's the thing about financial modeling is it's a lot of things, right? It is a break-even analysis tool. It is a, you know, articulation of your growth strategy. We can see here, if I'm an investor and I'm saying, hey, how do you plan on growing your business? Then I can articulate that through here mathematically. But even more importantly than that, if I look at this, I mean, everybody here, everybody on this call can look at this and see where the risks are in this business, right? I mean, Mitch, look at that. Like all of it, all of my new customers are coming from organic website traffic, all of them way out here. So if I'm an investor and if I'm a founder, I've got to do everything that I can to de-risk that. I've got to invest as heavy as I possibly can in SEO. That means I got to get content out. I'm going to have to do everything that I can to make sure that is what's driving all of my, you know, all of my new customers. Because if I can't capture that, then my business is not going to be very interesting for anybody, you know? So good. So it's a articulation of your growth plan. It is a break-even analysis tool. It is a, you know, business analysis tool. I saw a question come in that asked about CAC and all of the unit economic stuff. That is absolutely something that we do in Forecastr. This particular one, we don't have that built in just because we're keeping it simple for this demonstration, but absolutely that is something that we provide. So it gives you good visibility onto the unit economics of your business, and it's a cash planning tool as well. I mean, we go in, we use this to see who can we afford, who can we hire, how are we going to augment our team, all of that stuff. It's just a holistic simulation of your business, a mathematical representation of your business. And once you've got it really dialed in, this is why our customers love us so much. This is why we have a 9.8 out of 10 net promoter score, is because once you get it super dialed in, it's the most powerful tool in your arsenal. It really is. Cool. And is this applicable for theoretical forecasting? Absolutely. I mean, I touched on this kind of like earlier in the slide where it's that business viability. Is my business even viable? And I'll give you a real world example, you know, for Forecastr ourselves. We originally, when we rolled out Forecastr, we'll get into kind of like the economics of what Forecastr costs and all of that. We were theorizing it being a freemium business, you know, have people use it for free and then upcharge and charge monthly and all of that stuff. Once we actually modeled that out, though, we realized that in order to make this work and be interesting for a VC, we'd have to get like 70, 80% market penetration. It just doesn't lend itself to a freemium business model because our market is very niche. You know, it's a relatively small market, not, you know, it's a big market, but relative to like a Spotify or a Netflix, like it just doesn't work. So for us, I mean, that gave us great clarity very, very early on. Before we charged a single customer, we were like, okay, this is something that is not going to lend itself for this type of business model. Let's try to find another business model that works. We ended up landing on the annual subscription business model, and it works great for us. It's perfect because it's still a low price point, but it's a way for us to be able to monetize our niche market in a way that's fair for both sides. So that's just one instance, but that happens all the time with our customers that are still trying to figure out theoretically, what is my business supposed to look like? What is that business model that I need to use? Forecastr is great for that. It's kind of the value prop of a financial model. It morphs over time. Early on, it's testing and understanding what is the optimal path that I want to charge forward to. But then as you get bigger and bigger, like where we are now for our own company, for Forecastr, now it's more understanding where to focus our growth strategies. We've got our revenue formula nailed down, but it's like, how do we dump as much gas into that fire as possible and really grow? Cool. I'm going to jump back into the presentation now because we've only got, I think we're running slightly behind schedule. But you'll see that, there's a lot that actually goes into building a financial model. And we're, not going to be able to go through all of the content that's necessary if you do choose to build one from scratch. But I do want to talk very high level and provide some tips and pointers if you do choose, to go out and build this model on your own using like Excel or Google Sheets or something like that. So step one, we just talked about, but it's also by far the most important in understanding your business is just constructing that revenue formula, getting an understanding of what your revenue formula should look like. So I encourage all of you all, should you choose not to go with Forecastr, just try to recreate it yourself, try to identify all of the inputs, then simulate your revenue formula through a financial model. And to do that, we're going to need to understand your customer acquisition channels. So we just saw this with Dollar Cave Club. What are the ways that you're trying to get new customers and trying to understand all of the math behind each of those? It's also super important for you to articulate your growth strategy through investors. So you're going to want to put those two things together in order to forecast your revenue stream. And then you're also going to need to forecast all of your expenses that correlate with those revenue streams. So this is where we're going to be forecasting our cost of goods sold, or COGS, as shown here on this slide. And it's meant to show the direct cost associated with producing your goods or services. So if I sell another dollar of revenue, how much cost is going to be associated with that? You're also going to need to forecast all of your indirect expenses, so alongside your revenue stream. So you're going to need to forecast your operating expenses, and that's whenever we're going to move to the balance sheet. It's where you're going to be looking at all of the things that your company owns. So your cash, your accounts receivable, debt, so things that your company owes money on as well. All of that stuff's going to be really, really important. Once all of those are done, you're putting together everything in the financial statement. So you're going to be putting things together in your monthly income statement, your monthly balance sheet, and your monthly cash flows. And we do monthly intentionally. Investors think of things in terms of monthly. So it's also a good cadence in which to review your financial model. It's kind of that monthly cadence. You're going to want to annualize those statements as well too, though. So investors are going to want to look at your business holistically in a defined time period. So how are things going over year? So have them monthly, have them annually as well. Of course, all of that's done for you in Forecastr. Once you got everything put together, you're going to want to use it to understand how much money you should raise. It's a relatively simple once you get your model complete, because you can go in to see how negative your cash goes without a fundraise, and then you can throw in margin of safety on top of that. So we kind of did that in our example. We threw in $2 million. We saw how long that got us. So that gives you an idea for the minimum amount of money that you're going to want to raise and how long that money is going to get you. It'll also help you lay out your plan for how you're going to be growing the company. So like for your customer acquisition strategies, what are the individual metrics that you're going to need to hit in order to hit your forecast? So like in the one that we just went through, we saw what the cost per click was. We saw what the monthly budget was. So it's trying to understand what does the conversion rate need to be on that if you're going to continue to hit that, and then measure against that. You'll be able to take a snapshot of your financial model. You'll be able to put it in your investor presentation. Then you can use that financial model in due diligence in kind of like with a link into your data room. That'll help you whenever you're actually trying to raise money. You usually want to use that financial model that you put in like an investor presentation or something to try to set up a one-on-one walkthrough meeting once you've had that initial pitch meeting. So usually the way it works is you've got the pitch meeting, the individual, like the intro meeting to the investor. It's usually got a snapshot of your projections. Your investor will ask questions about those projections. You then use that point of interaction to try to get that next meeting. And that next meeting is where you're really going to dig into the specifics in your forecast. So now we're going to kind of shift into how to execute that next meeting, where you have that deep dive into the forecast when you're going through due diligence. So we kind of break this up into 3 different time periods, kind of obvious, but it's really what you want to do before the meeting, what you want to do during the meeting, what you want to do after the meeting. So I'm going to break each of these down individually, and I'm going to talk about them kind of like in their siloed space. So before the meeting happens, you don't want to send them your financial model. And people have very different opinions on this, but we feel very, very strongly here. You don't want a model to live on its own. You need to control the narrative, and you want to present your model to the investors or on a call. And this will do a couple of things. One, it'll give you leverage to get that next meeting. So if they're asking you questions about your business and they really, really want to dig in, then they need to do it with you in the room. It'll demonstrate your understanding of the model when you do present it. So that's kind of the second thing. It'll demonstrate that you know your numbers. And in showing your understanding of the model, you're showing your understanding of the business. Because remember, the model is a simulation of your business. The two directly translate. It's a mathematical representation of your business. But really, most importantly, it allows you to control the narrative. So similar to pitch decks, when an investor sees your model, immediately they're going to start forming their own opinion on it. And you want to be there while that's happening. You want to be in control of how their opinion's being formed. It's really easy for an investor to get the wrong impression of a model without context. And like it or not, once that initial impression is made, it's really, really hard to change it. Even if the thing that's like giving them pause is totally explainable. So you want to be there, you want to be present, you want to present your model. And then when you're doing that, when moving into during the meeting phase, you need to be in control. So people go into these meetings and they're ready for battle. They're thinking that they need to defend their financial model. They need to defend their projections against the big bad investor that wants to just tear them to shreds. Don't let that happen. This is a working session where you and the investor are working together, and you're using the model as a tool to analyze what you think is realistic for your business. So you present what you think is realistic, and you all have a discussion about that. If they have different opinions, model them out, do some real-time scenarios, ask about their opinion, show that you really value their input. Remember, it's a working session. So, you're also showing the investor how well you two are working together. You want to respond to their ideas. You want to offer some of your own. You want to present, but you also want to use it as a brainstorming session. If you know your model well, this shouldn't be a scary meeting at all. And it's always perfectly okay to say, I don't know, let me dig into that if they ask you a really, really hard question. After the meeting, always follow up. Something that Techstars taught us, they call it play like a champion. But every time that you meet with somebody, you're always going to want to follow up on that meeting. You're going to want to summarize what you talked about in an email. Then and only then are you going to want to include a copy of your financial model. If they asked about a specific scenario that you didn't have time to get into during the meeting, go ahead and run that scenario, summarize the outcome, and send a version of the model that has that scenario in it. And if they asked you a question that you didn't know the answer to, follow up after talking to mentors, people in the space, and try to get a good answer to that question. Follow up with them, then have a really good answer for them. By the way, we're always open whenever founders get tough questions from VCs that are finance related. Let us know. We love answering tough questions. So more than happy to offer our expertise there. And if the investor said something that prompted you to do further analysis in the model, tell them about it, show them. It's always a great way to earn brownie points. Say, create a scenario. Hey, I ran this scenario about that thing that you brought up. Here's what I found, that type of stuff. They eat that up. So that's always really great. Just show holistically, you're just wanting to show them that the meeting was productive and that it meant a lot to you. Once you've secured the investment and you've got your financial model operationalized, we're going to want to make sure that we keep that updated every month. So one good thing to do once you've updated your model is to compare it with what you thought that you were going to do. So we call this a forecast versus actual analysis. It'll help you stay on track and identify individual variances within your model. Then you can update your model based off the variances and get more and more accurate, and therefore the model becomes more and more useful over time. We also encourage you to run multiple scenarios and use it as a planning tool to understand the types of impacts that different metrics will have on your business, and it'll really help you stay on top of your runway. So I'll give you another real example. Forecastr is going to start offering more heavier support packages. We came to this decision after making a scenario in our financial model and understanding what would happen if X amount of people would pay for these packages. There's an enormous impact. So we used our model, we theorized something, we ran a test on it, and we decided to operationalize it. That's the type of stuff that the financial model will help you do. Those types of really strategic decisions are really, it's really important to use your financial model when trying to make those types of decisions. We also recommend using your model as a reporting tool. So you're going to want to, send copies of your model to your investors and do forecast versus actual, send those types of reports over to them. And we recommend doing it on a quarterly basis as well, and including it in board reports, board presentations, all of that stuff. Really good, strong financial hygiene that'll pay dividends down the road. So that was a lot of information. That's pretty much everything that I had planned to cover, but we got about 8 minutes left. So I do want to leave the floor open for some questions. And actually, I don't think, must have skipped over the slide that details this, but I'll just say it here. In terms of like how Forecastr works, we do offer an annual subscription. So we only do annual subscriptions, kind of like what I talked about earlier. The sticker price of that subscription is $2,000 a year. However, all of you all are coming to us through a trusted partner, which is NewChip. So we do offer a 25% discount off of that sticker price for the first year. So that would bring your first year price to $1,500. And that comes with a lot. So everybody that is a Forecastr customer, we take them through a white glove onboarding process. It's where we pair you up with 2 analysts, and it's their job to get to know your business, fully understand it, and work with you to develop a financial plan, construct that revenue formula, put together a financial model for you. So it's very much kind of a blend between SaaS and services for us. We lean hard on our analysts, and like I mentioned, 9.8 out of 10 net promoter score. So people really like what we're doing. So if that is interesting to you, Mitch has sent the beta application through a couple of times. So just go ahead and click on that link. We encourage everybody to apply. And yeah, now I'll pause and see if anybody has any questions.
Yep. Thanks, Logan. I'll give you a break and let you drink some water. In the meantime, thanks everyone for dropping questions in the chat and stopping in there. Yeah, we appreciate the interaction. I will, by popular demand, be sending out a follow-up. We'll send you guys the reporting. We'll send you the slide deck. But yeah, we'll be hanging around for the next 5 minutes. Feel free to drop questions in about your business in particular. Like, we're happy to use this as like some one-on-one time if you want. And then also in the follow-up, you'll have our emails. So if you do run any questions about your business, feel free. We're an open book to kind of help out. So yeah, just want to drop that in here.
Yep. And Mitch, did you send? And sorry that I wasn't paying a ton of attention to the chat, but okay, yeah, it looks like you did send over our contact info. So more than happy to schedule one-on-one time with anybody. If you guys want to drop us a line via email, our email addresses are in the chat.
Yep, awesome.
Yeah, we'll give it like a minute or so, but if there's no questions, then we can just go ahead and shut it down and give everybody a few minutes back.
Yep. Yeah, I was going to say getting early lunch in, but since we got people from all over the world, so oh, here we go. We got a question drop in. So he has a per sale commission we make plus subscription per customer plus subscription per expert listed on our site. How does he handle that?
Yeah, so you're one of those like more complex business models. So it's something where, like in Forecastr, a lot of times you'll have this where one customer will have a multitude of revenue streams tied to it. But it's just one of those things where you may have a complex revenue formula, but you do have a revenue formula. So in this case, it might be something where if you have a commission per sale, like you have one customer, that one customer pays a subscription, but then that same customer might make a purchase you know, at some sort of interval. And that interval would be an input. That'd be something that you have influence over. So if I'm like, let's just pretend like we're talking about Amazon here. I know Amazon doesn't work this way, but we'll just pretend. Let's say that I have to pay $10 a month to be on Amazon. Okay, so I've got my $10 a month, but I might buy 3 things from Amazon per month. You know, that three, you know, the frequency at which I purchase things, that's an input, right? You have indirect control over that. You can try to influence and modify behavior to get that up. You can try to send more emails. You can try to like engage with them harder. One of your indirect inputs that you would want to see, is this the thing I should be focused on? You also have 2 more inputs when it comes to that. You've got your commission rate. That's something that you have a direct influence over. You can always just increase the percentage that you take on a commission, but then you also have another indirect input, which is going to be your purchase value, which is something that, again, you can indirectly control. You can try to steer people more high-priced, like towards high-priced packages. So it's just mapping out kind of like all of the inputs that you have. And then you said you have a subscription for expert listed on your site. So like if you have another subscription that exists on top of that, perhaps not everybody has that subscription, but you want to include like, you know, percentage of user base that has this more enterprise level subscription or something like that. But it's essentially just taking that one customer, really mapping out their journey, and you can do that through a revenue formula. And I'm more than happy, you know, this is something that our analysts eat up. You know, they love thinking through more complex revenue formulas, and they would definitely work with you to put that together in Forecastr. But that's kind of like high level how you want to think about these things. Like, what are the behaviors? If I have 1 customer, if I have 10 customers, what are the behaviors there? And mapping that out mathematically. So, and yeah, would love to chat with you in more detail about it.
Well, cool. Looks like we don't have any more questions rolling in. So yeah, appreciate you guys stopping by, and
one more that just came in. Mitch.
Yeah, go ahead. Take a look.
Our model into Excel file. So yes. So the answer is yes and no, I guess, would be like the honest way to answer that. So you can export your model into an Excel file. It's going to be essentially a CSV file, so it's going to be data only. However, as a part of our white glove onboarding and as a part of like continuing services, if you want to check those out, we do offer a full formulaic Excel export as well. That's going to be kind of like a man behind the curtain export, where our analysts will work with you to get it translated one-to-one from Forecastr to Excel, but that is included in that price. So yes, we can do that.
Cool. Well, all right, everyone, I'll be following up with the recording of the webinar here, and then of course the deck by popular demand. And yeah, you'll have our emails from there. So if you guys have more questions, shoot them over. And yeah, Logan, any final words, man?
Nope, don't think so. Appreciate everybody for jumping in. Good. I always like these webinars that are very interactive. So thank you guys for interacting on this stuff. It makes it a lot more fun for me. So I definitely appreciate it, you all.
Cool.
All right.
Thanks, guys. Cheers. We'll cut it off here. But yeah, thanks for dropping by.
All right. Bye.